Hello and welcome to our monthly stock and economic update. In this video, we cover what happened in financial markets in February and what it means for everyday investors. February was a good reminder that markets do not always go up in a straight line. After a strong start to the year, U.S. stocks dropped due to a Supreme Court ruling on tariffs, worries about artificial intelligence, weaker economic data, and the rising tensions in the Middle East. Despite these bumps, the broader economy is still in good shape, company profits continue to grow, and there were some positive signs in international markets, smaller companies, and bonds. Let's take a closer look at the key events. First, the biggest policy news of the month was the Supreme Court's February 20th ruling against the administration's tariffs. Tariffs are fees charged on imported goods. This ruling has wide-ranging effects, including possible refunds to businesses and consumers. After the ruling, the White House quickly turned it to the other trade laws, including Section 122 of the Trade Act of 1974, which allows a president to apply tariffs of up to 15% for 150 days. More measures are expected to follow. For investors, the main takeaway is that while the legal tools for applying tariffs have changed, the overall direction of trade policy has not. Uncertainty around trade will continue to make headlines and cause some market swings. But history shows that markets tend to adjust to new trade policies over time as companies change how they source goods and set prices. Reacting too strongly to these policies last year or back in 2018 would have been a mistake. Next, artificial intelligence, or AI, remained a major theme in February. But the focus shifted. Instead of excitement about AI's potential, investors started asking whether AI could actually hurt existing business models. The concern is that AI could squeeze profit margins for software companies, replace many professional jobs, and disrupt many kinds of businesses, including technology companies, faster than most people expected. These worries led to a shift in the market. Investors moved away from very large technology stocks and towards sectors seen as harder to replace by AI, such as energy, materials, and industrial companies. This helps explain why the NASDAQ, an index heavy in technology stocks, fell over 3% during the month, while other parts of the market held up better or even gained. For long-term investors who had been worried about high stock valuations, meaning stocks that may have been priced too high, this kind of shift is actually a healthy sign. It points to a broader and more balanced market, which is generally positive. Finally, one of the most encouraging stories this year has been what has happened outside of large U.S. stocks, specifically stocks in developed international markets, gained about 4.5%. Stocks in emerging markets, meaning developed countries, rose over 5%, and smaller U.S. companies also posted solid gains. So far this year, international and emerging market stocks have outperformed the S&P 500, which tracks the 500 largest U.S. companies. This wider spread of market gains matters for investors who hold a diverse mix of investments. After several years where a small group of large U.S. technology companies drove most market returns, seeing strength in international stocks, smaller companies, and other sectors suggests investors are finding opportunities in a broader range of assets. Looking ahead, global events including rising tensions in the Middle East following strikes against Iran are worth watching, especially for any impact on oil prices. We hope you found these insights helpful. If you would like to learn more about any of these topics, please don't hesitate to reach out. We look forward to speaking with you.